Jordan, hello. So good to see you. And welcome to everybody who's watching live. Jordan, how are you?
I'm doing great, Aaron. I hope you're having a great day. It's cold and snowy in Chicagoland, but we're making the most of it. Soon it'll be warm again,
Brutally
hopefully.
cold. Yes, yes. Now we have a lot to cover, a lot of year-end tax planning, having important family conversations.
Yeah.
So I have to ask, how was your Thanksgiving?
It was great. Nice to reset, relax, spend time with my little 2-year-old, which is a bundle of joy and a lot of fun. And it's nice to just reflect on what life's meant to be with family, with friends, and just enjoying the simple things in life.
I can't believe he's 2 years old now.
2.5 almost, and
That flew
he's
by.
talking more and jumping and running a lot. And I have a lot of respect for all parents having a child. I see what people go through, and but a wonderful blessing with that.
It is. And, I think that's a great point for us to kind of start this conversation because, Jordan, I know that family is very important to you. It's part of the culture with you as well. And that's why legacy planning, I feel like that goes hand in hand. So, as we talk through some of these year end stories, let's start with why 60% of wealth transfers fail and the
Yeah.
conversation that every family should be having this holiday season. The holidays, of course, bring families together. We are all under one roof, which is why it's also a great time to talk about family finances and the legacy that you want to leave behind. So,
Yeah.
Jordan, I was really surprised to learn that 60% of wealth transfers fail because of a lack of communication and trust. Why do you think it's so hard for families to have these conversations?
Yeah, I mean, it's a lot of things to talk about, especially when it comes to money. People just don't want to talk about it, and I think having that proactive communication is crucial to ensuring your assets get transferred to who you want them to go to make sure things go smoothly. And sometimes, trust. A lot of people keep things close to their chest, but you need to have that trust. It's your family. You love them. You got to be more open with them because these things are so vital to make sure your wishes and what's in for your family's best interest are actually handled and executed when that does transfer and that wealth does go to the next generation.
Yeah, it's interesting, isn't it? Because I think that this kind of brings up two topics that a lot of us are uncomfortable talking about in general,
Yeah.
money, but also death, right? Family
Yeah.
planning. So that probably makes it a little bit stickier.
Yeah, no one wants to talk about when you get sick or when you pass away. And there's so many different things that you can plan ahead to make sure things go. Obviously, it's horrible when someone gets sick, when someone passes away, it's super sad. But if you love your family, if you care about your family, you can do some of these things proactively so everything goes smooth and it minimizes the emotional or financial burden on the family. But talking about death is not fun, and it's not something that we like to do at family time or around the holidays because it's a tough subject, but it's something that needs to be addressed.
Right. So why though, as we're making the case for people to sit down and have this conversation, why might the holidays be the best time to have this conversation?
Well, we're very busy. Everyone's always across the country or maybe doing their things with their jobs. This is the time to really be together as a family underneath one roof, as you mentioned, and really have these heartfelt conversations because you love them, because you care for them, and you want to make sure that their interest and the family's interest are all served. So when you're all together, when you're all in that same room, that's when you can be transparent and honest and be proactive in a plan to make sure that the family knows what's going on, why it's going on. I'll give you just a simple thing is powers of attorney. We do a lot of estate planning in our office and just making sure not only does each one of your family members have someone that's designated as a power of attorney for healthcare or financial, but make sure the people that they are designated, they know where to access those documents.
Mhm.
Surprisingly, some people have these documents, and then the person that's their POA for financial or healthcare, they can't find these documents. So these are just some simple things to start the conversation to make sure we love our family and we communicate with our family when we're all together.
Right. And you've been doing this for a long time, Jordan. I'm sure having these conversations when it's not under acute stress, like in the moment, either somebody has a bad news diagnosis or somebody has passed, like having
Yeah.
this conversation proactively probably makes it much better and much easier.
Yeah, emergencies are never planned,
Right.
right? The things happen in life. So when we're not under the stress emotionally or financially, we want to make sure we make these wise decisions while we're calm and collected. Usually, this time of the year, things slow down a little bit. People take some time off. You have time off with your family. These are where you can make wise, calculated decisions and have those conversations to make sure we're not making a knee jerk reaction in a crisis situation, because
Mhm.
emergencies in these situations are not planned, but they do occur. That's why we got to plan for them now.
Mhm. So let's get into some specifics here. You mentioned power of attorney. What other information should parents or grandparents be sharing with their adult children?
Yeah, I mean, it depends on trust, and you know your children the best. But you want to make sure that you have a plan and let them know that you have a plan. Let them know who your advisor is, and let them know if something happens to you, what's going to happen with this money. Maybe you have a few kids and a few houses, and maybe you say, "Hey, Johnny or Sally, Johnny, I want you to have this house, and Sally, you're going to have this house." And we have a plan, and we communicate that plan because you love them, and you want to make sure that everything is following through in your wishes, and make sure they know where to find those legal documents. Hopefully they have a folder that says, "Hey, go to my financial advisor. He has my
Mm.
trust, he has my investments, he has everything that I need all together, and he can help facilitate that wealth transfer and answer any tax questions or any financial questions you have."
And what are the most important legal documents that every family should review together?
Yeah, so we like to have at least a will. A will is vital. Having a power of attorney for healthcare, a power of attorney for financial things. We also like to have a trust to protect those assets from creditors and make sure that we kind of just have a little bit more safety nets inside the plan.
Mhm.
Also, some people want to control the assets even after their death. Well, if we just name a beneficiary, you don't have a control. But if you put assets inside a trust, you can stipulate, hey, you don't get the money lump sum, you get it over 10 years. Or maybe how much money you make is how much money we kick out of the trust to teach them responsibility. Because human nature, if somebody younger or even anyone inherits a lot of money, they're more inclined to spend that money unwisely. So maybe because you love your family, you want to
Right.
split that over multiple years. But
Yeah.
having a trust, power of attorneys, those are things that we like to look at upfront, and hopefully having a plan so that they know kind of what's going on, and from a tax perspective as well.
Right. Beyond a financial plan, though, Jordan, it sounds like what you're talking about is an estate plan.
Correct. And we kind of cumbersome all those together because in our process, we do a financial plan, an estate plan, a tax plan. We make sure all these things are working together to really benefit our clients.
Hmm. And so, again, you've been doing this for a while. Family's important to you. Do you have any tips on how to keep these talks positive as opposed to uncomfortable? How to get the ball rolling?
It's something I'm gonna just tell you off the cuff. When I talk to my family, is it, do you want to leave more money to the IRS, or do you want to keep in us as a family? And oh no, I don't want to give more to the IRS. Well, that's our goal, my family's goal. I think most people's goals. So just having these conversations can literally mean saving the family tens, if not hundreds of thousands of dollars in excess taxes. Also, it can save a lot of emotional stress because when emergency happens, like we mentioned earlier, it's not the time to make these crazy health decisions or ask someone in a crisis situation what's your wishes. But if you're well thought out, if you plan ahead, if you have your wishes in writing and who's going to execute those wishes, it's to alleviate stress. It'll minimize the impact it has emotionally on the family. And it really just makes sure everything goes so much smoother. And you don't create these trusts and these documents because you're trying to be greedy. It's actually because you love your family. And,
Right.
and that's the motivating factor.
Right. It's not even necessarily about you. It's about
Yeah.
setting your family up to not only your legacy up, but also so that they can focus on celebrating your life as
Yeah.
opposed to arguing over, the estate. I think that's really important to think about it as a gift to your family.
Yeah, again, and death is not fun, but death and taxes are something we face in this life. But one thing we try to do is, talking about celebration. When a client of ours passes away, we sometimes create what's called a love card for them,
Mm.
which is a video message they send to us or we help record for them that really speaks to their children and their family members, how much they meant to them, the memories they had, how they enjoyed seeing them make these accomplishments. And when we deliver that video with the financial plan and we help, assets transfer and all that, they don't care about the dollar signs and the assets. That video means more than anything. It's
Of course. Yeah.
priceless.
Right.
So,
Oh,
so
what a
that
great gift. Yeah.
it's a nice thing to touch. And I don't recommend doing this in your late 80s, 90s, but do it while you're healthy, do it while you're young. You can always update it. But like we said, emergencies are not planned. Things can happen. be proactive on these videos because your family will thank you later.
Yeah, well said. Well, as you're mentioning, though, death and taxes, let's talk a
Yeah.
little bit more about taxes now. Of course, as we record today, it is December 4th. So
Yeah.
a lot of the money moves that you probably wanted to make maybe should have happened already, but let's talk about what we can perhaps still do before the year is over. So first, we would suggest consider maxing out your 401k. I mean, this is good advice no matter the time of year, Jordan, but with the few paychecks we have left in the year, we can either perhaps increase the contribution or increase the Roth contribution if that's something your employer offers.
Correct. So you want to look at kind of your overall plan and look at the cash flow. Obviously, a lot of people sometimes spend more this time of the year too. But if you have some extra cash on the sidelines and you financially can afford it, you might want to allocate in your 401k to put more money into that traditional or a Roth 401k. So that actually will mean they'll take less, you'll get less kind of your paycheck into your checking account, but you'll be able to funnel these things in these tax advantage accounts to give you tax advantages maybe now or in the future. So it's a great way before year end. If you have some lazy money on the side and you really don't need to put more in that bucket, allocate more of that money from your paycheck to these 401ks. That'll literally help your family by thousands of dollars over
Right.
time in compound interest and make sure that we maximize those benefits that we have.
Right. And just a friendly reminder to everybody watching live, if you have any questions as Jordan and I talk through these year-end tax tips, feel free to leave them in the comments and we will ask Jordan your questions. All right. Number two, make sure that if you have a high deductible health plan, you are contributing to your health savings account. I know, Jordan, these are one of your favorite because they are uniquely triple tax advantaged.
Huge. And I'm going to go even deeper on this. I mean, these are obviously tax deductible when you put the money in. It's tax free in the growth, and you can take it out for so many qualifying expenses when it comes to medical matters. Maybe Medicare in the future. Maybe it's a lot of different things. Even sometimes gym memberships can qualify for
Yeah.
these HSAs. So it's a great way that we will all use at some point, usually in our life. So when you put money in that deduction, you have to make sure that you first have a high deductible health insurance plan, because if you don't have that, you can't legally contribute to those. Now, some people, obviously their employer gives them some options, sometimes not. In our company, give people two different options if they want to do a high deductible or not. But using the high deductible, a little bonus tip for you: say you don't have that extra cash, right, to kind of invest in that, but maybe in 3 months or 2 months you have a medical bill that you need to pay. Instead of just paying that bill, say $500, even if you just put that in the HSA, $500, take it out the next day to pay the bill, you just got a $500 deduction. So
Yeah.
obviously it's great if you can grow that money compound, but even if you can't, use that HSA as kind of a funnel to then pay that bill and you get a tax deduction. Easy money, more money back in your pocket, so to speak. Here's a second layer to this is when you put money in an HSA, yeah, you get the deduction, yeah, you can grow tax, free, but it also gives you some flexibility because again, this is our healthcare system. I'm not going to be overly negative today, but our healthcare system, it's crazy the inflation on there. And
Mm,
sometimes you need a MRI or a procedure, and let's just say whatever that is, it's $1,000. And you say, you know what if I just paid you, what would I pay if I paid you cash? Oh, it'd be $200. You could take $200 from your HSA and pay that, and you might even get a discount because maybe you weren't going to hit your deductible for the year. So it gives you some options and some flexibility and even negotiating the price for different healthcare services.
mhm. Right. And then you brought up an important point, which I think a lot of people may not recognize, that not only should you be contributing to your HSA, but make sure you're investing that money so that it
Yes.
can grow if you're planning to use it as a retirement account.
Yeah, I had some residual cash, about a couple $100, actually last night, Aaron. I'm not even joking, and I bought some stocks and did some trades last night. But yeah, let that money work hard for
Yeah.
you. Don't let it just sit there stagnant, because then you're losing to inflation. So if you invest that, if you don't need the money, let that grow. That compound growth will be fantastic, and it's all growing tax free. Then you take it out for medical tax free. I think more and more people need to be educated on these HSAs because it's a great tool to kind of build up that nest egg for healthcare costs in the future.
Yeah, one of the biggest expenses in retirement. Good reminder. All
Yes.
right. Next, even though you do have until the tax filing deadline, this is your friendly reminder to max out your Roth IRA.
Correct. So you have technically till April 15th the following year if you want to add money to your Roth IRA or traditional IRA. But we want to make sure we take advantage of these tax-free buckets or this Roth IRA. Obviously, there's some income limitations that you maybe if you make a lot of money, you can't put as much, but there is no limit on that income when it comes to 401k Roth. So you got to look at your individualized situation, but make sure you get as much as you can in that tax-free bucket because me, like many people, believe taxes have to go higher. So we want to make sure we pay the taxes now while they're on sale, get more money sheltered tax free. So if we give it some time and some compound interest, we can have a bucket of money that we can draw from that we don't care what the tax rates are when we draw from it because it's still going to be taxed at zero because we have it in that Roth IRA.
Right. And as we talk through these year-end tax tips, I think part of the confusion with contributions to those Roth accounts, Jordan, as we mentioned, that goes until April 15th, but
Yeah.
conversions do have to happen in the calendar year. However, I don't know about your office rules, December 4th, we might have already missed that window.
Yes, we are proactive. So fourth quarter usually start in September. We do a lot of tax planning to see year-end kind of income simulations. And usually I think right now 98% of our Roth conversions are complete.
Yeah.
Again, I'm going back not yesterday, I'm going back 2 days. I saw someone in our office that had a few $1 million in IRAs. And I looked at their last year's tax return and they had about $35,000 of taxable income. And again, I'm not going to go too long-winded, but in a married top filing joint bracket, they have a lot of wiggle room to even do Roth conversions over $60,000 and pay it at the lowest rates at 12% versus what they may be in the future. Thanks for queuing that up. So basically, if they don't do anything before December 31st, they're going to miss out this entire year when it comes to tax planning. So sadly, we don't have enough time to transfer all the assets and do that for them, but we actually are helping them and calling their current 401k, and we're going to help them do the Roth conversions before the year's over because they cannot miss that December 31st
Right.
deadline
Right.
because that year is kind of lost. So
Yeah.
yes, contributions April 15th, but conversions have to done by December 31st. And I'm not saying it's impossible, but we're getting to the finish line. We got to be super proactive. If you're seeing this video now, you need to jump on this if it makes sense
Yeah.
based on your plan.
Right. Now, that being said, all the love in the world to our procrastinators out there. Even if you feel like you've missed the boat for 2025, it is certainly a great time to even start thinking about 2026.
Correct. We always going to be
Yep.
proactive and we've
Yes.
got to think about we create a tax plan. What does your long-term tax plan look like? Does it mean more Roth conversions? Now, say it does, and say you have a plan. This is what we do for our clients. And I hope this doesn't happen, but say there's another quote unquote pandemic.
Mm.
Okay. And say in March or April next year, the markets take a dip instead of worrying and wondering about am I going to be okay, what's going on, one, if you have a plan, you're not stressed, you're still enjoying life, and hopefully your advisor at that point in time is providing financial leadership. Because if you have a tax plan to do Roth conversions and the markets just dip, that is the ideal time to do the Roth conversion at a lower asset value, pay less in taxes. So historically speaking, the markets always recover, and that growth recovery will be tax free. So you can't really do that unless you have a plan. But we always got to think about this year at closing, but also next year, what are we going to do? What's our income looking like? So we can hopefully execute on that plan in 2026.
Mhm. All right. Next, also a good time to consider selling our stock losers. This is known as tax loss harvesting.
Yeah, and I'll say, this could go for losers. It's also good to go for winners because maybe you have Nvidia and you have these highly stocks. And again, I'm not saying they're bad, but because they've grown so much. But maybe you want to sell off some of those gains, kind of help diversify your portfolio and not be overly weighted. And maybe you want to sell some of those maybe not so great stock performers, and that can offset the gain, so you pay no taxes on that. Or maybe you have some stocks that are just, not doing so well that you can sell off and you can actually take that loss and apply that to your tax return where you get a deduction for that tax year. So these are the things you have to do before December 31st. Make sure that you plan ahead. Make sure you look at your cost basis inside your non-tax advantage accounts and see how you can do some final year-end tax planning to save you some money in taxes and offset maybe some gains in some other positions.
Mhm. And then last, of course, be tax smart and do good. Donate to charity. Now, again, as we
Yeah.
think about forward planning, Jordan, I'm sure you know this already, in 2026, even if you do not itemize, you can still deduct $2,000
Yes.
if you're married filing jointly. That's one, strategy to think about. I know you also are a proponent of qualified charitable distributions.
Correct. So this is the new July 4th big beautiful tax act or tax bill that some people have got used to. I always give to charity, but I can't itemize. I always take standard deductions. So now I just don't even give my accountant the receipts, or I don't put that on my tax return. If you're watching this, you need to make sure you track those receipts. You do give
Right.
that to your accountant, because it's for a single person, you can deduct 1,000 over your standard deduction. For a married couple, you can deduct 2,000 over your standard deduction when it comes to charitable distribution. So that's a nice benefit that can hopefully save you and your family hundreds of dollars. On top of that, if you're over the age of 70 and a half, not 73, but 70 and a half, you classify to do QCDs. So if you give money from your IRA custodian directly to the charity, as you see in that visual, it doesn't go to you, it goes directly to the charity. That classifies as a QCD, where you don't pay any taxes on that IRA distribution. We just had a client, actually a new client last month. They give $20,000 or so to various charities. They were giving cash out of their account for the last few years, and we
Yeah.
said, stop doing that. We can send it from the IRA. You don't pay any taxes on that. So it's a great way to kind of get a tax deduction, help a charity, so everyone wins.
Yeah, that strategy is one of my favorites. Just to say it in other words, if you are putting money in the collection plate, there is a more tax efficient way to do it. And also, this is a strategy that people use, Jordan, when they have to take those required minimum distributions. The money has to come out anyway, but maybe you don't need
Correct.
the money. You just send those RMDs right to the charity.
Yeah, so you can do it at 7.5, but once you reach 73 or 75 based on your date of birth, you're required to take the money out. And if you don't need the money, you can send that to classify or to supplement that RMD, so that you can take that money out, not pay any taxes on it. It's a great way to kind of just give more to those charities that deserve it, they need it, and
Mm.
pay less to the IRS.
Hmm. And Jordan, I think this is a good time just to reiterate that legacy planning, what we were talking about just minutes ago, also helping people in the world around us, charitable planning, estate planning, this is all part of your investment philosophy. This is what people can expect if they were to call you with any financial questions.
Yeah, I think we're very unique. I think we separate ourselves than many advisors that just focus on the investment management, stocks, bonds, mutual funds. I think we have evolved, and we need more value added to the clients that we serve. So we lead everything with tax planning. We can even do tax preparation because tax season is coming around the corner. But we make sure that every investment decision has a direct correlation to the tax plan, and we educate our clients on what we're doing, why we're doing it, and how it affects them from a tax perspective. Also, income planning, these different things that tie into taxes, healthcare, legacy. We want to make sure that all these pieces work together. And Aaron, I don't know if I mentioned this to you, but we have a ton of estate planning workshops in the next few, actually over the next year or two, that we're educating people on that. So this week we already gave two. We give Medicare and healthcare workshops. We give tax workshops. We give investment and income workshops. So in all those five kind of key financial areas of the roadmap, we are giving education in the community, and we have things on YouTube and different videos to really
Mhm.
help make sure that we show people these all work together in unison. And if you have one thing not part of that plan, that can really kind of put stress on the other factors, and it could even derail your overall plan. Because if you make a lot of money and do these good things, but you don't have a tax plan or a legacy plan, you might be giving hundreds of thousands of dollars to the IRS, and you didn't name them as a beneficiary.
Right, exactly. That being said, so Jordan, if somebody wanted to attend any of these seminars, do you have that up on your website, or how can they find out more about that
Yeah.
information?
They can go on our website. It's on our workshop tab, and they can just click on that link, and they can kind of see. We show only the next 10 events out there, but we have things booked for the entire 2026 year. We have some fun things going on as well. Again, I know we're not going to have a ton of people watching this live today, but we do have actually next week, we're showing a movie, The Psychology of Retirement, and we rented a
Mm,
few hundred-person movie theater to kind of show that movie, just to kind of educate the community, because there's a lot of people retiring. There's a lot of changes in economics and politics and the economy, and we want to make sure that we help people navigate through these and provide that financial leadership that they deserve.
I'm glad you brought that up. That movie is by Morgan Housel. Well, he was a
Yes.
consultant producer, which The Psychology of Money is one of my favorite books. It must be one of yours as well when it comes to money.
Yes.
Yes. Yeah. Have you read The Art of Spending yet then? His next book?
I have not read that yet.
I haven't
No.
either. It's in my Amazon cart, I think. Okay, last bit of trivia. Jordan, do you have any favorite must-see holiday movies?
I don't have any must-see holiday movies, but I will say a movie that ties back to what we talked about legacy, is The Ultimate Gift.
Okay.
Have you seen that, Aaron? I don't know if we
I have
talked
not.
about it. Okay.
No.
So I think it's a great feel-good movie. It teaches about money, it teaches about legacy, and to be very transparent, that's where we borrowed that love card idea. And when you
Mm.
see that movie, The Ultimate Gift, you'll see how it comes full circle. And I think it's a little bit of a tearjerker, a little bit of a life lesson, but it's a really feel good movie at the end of the day. And I think more people should see that.
I'll have to check that out then. Thank you for the recommendation. All right, Jordan, thank you so much for making time today. Thank you to those who watched us live. And for those of you who are watching on the replay, don't forget that you can always leave a question in the comments below. And we look forward to doing it again sometime. Jordan, I wish you the very best. Thanks again for making time.
Thanks, Aaron. Have a good day now.
You too.